All right, I just want to call your attention to that at the bottom of your screen. DoorDash beats there, but they do report a loss, and it looks like the loss is bigger than expected. We're going to take a look at that. Our reporter, Steve Kovac, is on the case. He's going to join me in just a moment. As a matter of fact, I can go to him right now. Steve, what do we see here?
Yeah, I'm right here. DoorDash, here we go. We got a revenue beat, $1.61 billion versus $1.52 billion expected. Loss per share a little worse than expected, Scott. 72 cents loss versus 41 cents loss expected. Growth in orders, by the way, flat quarter over quarter, up 23% with 426 million orders. And growth year over year, though, Scott, is decelerating pretty rapidly here. We got orders were up 69% in the year ago quarter, so compare that. And then adjusted EBITDA, nice little beat here, $103 million versus $57 million expected. And as far as Q3 guidance goes, we got gross order value roughly in line with consensus, $13 billion to $13.5 billion expected. We were looking for $13.19 billion. And then adjusted EBITDA for Q3, they're saying $25 million to $75 million versus $51 million expected. Looks like shares are up about 11% here, Scott.
Yeah, maybe better than feared. I mean, they have a tough pandemic comp, obviously, coming out of that. So you have Lyft as well. Speaking of bars that are high because of what Uber delivered. And by the way, you know, this is a stock as well that we've been watching. It's down 60% year to date. It's up 29%, though, from its low.
Yeah, let's break down these results here, Scott. Lyft effectively in line with revenue expectations at $991 million. Adjusted EPS, a very solid beat here, 13 cents. The street was looking for a loss of 3 cents. Adjusted EBITDA, also a solid beat here, $79.1 million, blowing away expectations of $20.5 million. But those net losses growing significantly, up nearly 50% from the year-ago quarter to $377.2 million. By the way, I chatted with Lyft President John Zimmer about all this, and he was telling me that net loss is largely due to a tightening around insurance payments and partnering with large insurance companies to hold that risk instead. And Zimmer telling me we're going to be getting some more detailed guidance than we have been throughout the pandemic on the call that begins at 4:30. So stand by for more, Scott.
Yeah, we certainly will. They've been spending a lot of money, too. I got Dan Ives waiting in the wings in a little bit to come talk about that. Steve Kovac, thank you very much.
Thanks.
Pop back on with whatever you have there. Dan Greenhouse, let me bring you into the conversation, too. An interesting note today from J.P. Morgan, which talks about why we're rallying. Right? We mentioned what mega cap tech has been doing. The market's what I think is an amazing ability to look past some of this really hawkish Fed speak this week and continue to go up. Is it short covering? Maybe some, they say. Better than expected earnings from mega cap tech? Yeah, they say that too. Retail? Maybe retail's return. There's a ton of money on the sidelines that may be coming in. The catch on all this is they say at some point look for a flush day. With the VIX through 40 and the S&P down 4 to 5% as part of forming that bottom, suggesting that the bottom is not fully in. What do you think?
Yeah, I mean, it sounds like they're attributing just about everything possible to the rally, and I guess that's fair. I mean, when you have this vicious a rally over this short period of time, it probably is a accumulation of issues. I think you've been harping on this the last couple of days, the level of the hawkishness coming out of various Fed members who clearly wanted to come out in the wake of the dovish reaction to the press conference and walk that back. The Treasury market has not ignored that. To some degree, the equity market has. But just to tie this back to your main question, I know right now it's fashionable to say that the bottom is in and we're all done, and maybe so for now. But I think it would just be really unusual for the equity market and the credit market to have bottomed before the ISM even falls below 50, before you have meaningful earnings revisions. And the labor market just hasn't turned down at all. It would just be really unusual to have all this happen before those other things happen. And so I think that you still have a good chance, let's say, of additional lows, although not meaningfully lower, but further lows.
Liz, well, why has the market been able to look past all this talking this week, this tough talk from Bullard and Mester and everybody in between?
Well, I think part of it is that the Fed now has kind of introduced this veil of mystery and said that they were going to be data dependent. And the data is showing us that things are slowing down. And the whole point of this is to create enough slack in the economy so that we get inflation back in balance. We get supply and demand back in balance. But to Dan's point, I think if you look at just what the yield curve is telling us, and if you look at yield curve inversions historically and when a recession or maybe a new market bottom would form, it takes a while. So that's why I think for the next few months, we might be okay. And maybe even through the end of the year, you get past midterms and you see a nice rally on that too. You get through the end of the year and you could have some upside in markets. That does not, however, absolve us from having a deeper recession in 2023 if we don't solve the inflation problem. And solving the inflation problem means that it needs to come down quickly through the rest of this year, not just in little bits.
Kind of.
And Scott, let me just add real quick.
Go ahead.
Real quick. To your question about why the market's ignoring this, let's also be clear that it hasn't been sort of the senior Fed leadership from the market standpoint that has come out and made this case. It hasn't been Jay Powell. It's been we'll call them second-tier Fed members. And I think maybe if obviously the chairman were to come out.
But you know that, I mean, there's been some prominent people who have spoken this week, and it's like literally every single person who's come out.